Hello, FX Street. I don't recall who I'm referring to today, but first and foremost, I should give credit to anyone and everyone at FX Street who makes this event possible, especially today. Isn't today free day? I believe today is free day at FX Street, so at least some of you who may not normally have access to these webinars such as this one have access today, I believe. Correct me if I'm mistaken, which is good. Welcome one, welcome all. Yeah, today's free day. Good. Yeah, indeedy. Yeah, so let's get this event started. As you may have noticed from the web page, which previews or explain this event, what I do each week, and well, first of all, let me thank FX Street for what they do and for continuing to invite me back to these events. What I do roughly each Thursday at about this time, it's 1 p.m. New York time. What is it? 1800 GMT? I always get GMT confused, especially after a recent time change like we had here in the U.S. What I do at this time is spend about 45 minutes looking back at the trading week that just transpired. Usually in this case, the past 4 days of trading. Look at major moves, major technical moves, assess or discuss any major news events or headlines or what have you that appear to have sparked or at least contributed to certain moves. And then as time allows, or as depending on what the next week's calendar brings, I'll take a look ahead at some things that are on the calendar, or even things that may not be on certain calendars, but the things that I expect that could surface in the days ahead that could influence price action in the currency market. So again, it's sort of a look back and a look ahead. I'd say most of this next 40 to 45 minutes will be a look back, but I hope it, as time allows, to touch upon a couple of things to watch for in the days ahead. In fact, before I overlook it, I'll give you a preview. Next week is the first week of the month, and the first week of the month always chock full of news. Among them, all the PMI reports. Around the start of the month, often on the first day of the month, you'll see a number of purchasing manager index reports. It's the first look at the health of several economies around the globe. It's based on a survey of manufacturing executives, specifically purchasing managers and supply executives at manufacturing firms in the U.S. and Europe and parts of Asia, et cetera, et cetera. So that'll be those reports will be coming out early next week, and then you'll have several central bank decisions, namely the Australian central bank decision, which it seems based on recent price action on the Aussie that the market and increasingly anticipating a Reserve Bank of Australia rate cut. But I'm getting ahead of myself. So anyway, my point is, first week of the month, always a busy news week, and certainly next week, being the first week of December, no exception. So let's take a look here at what some major currency pairs and what has transpired over the past several days, particularly, I guess, the last 2 days. I did post a video, a so-called market alert video on FX Bootcamp's YouTube channel. I honestly meant to post it on my blog at FX Street and simply got distracted, never did it. But I typically do post just videos on my FX Street blog and plan to do so in the future here. The video I posted I posted about 15 hours ago during today's Asian session, and I want to touch on the content of that video. Let me go to my dollar-yen charts. Thank you, 1800 GMT. I see your comments about GMT. Yeah. All right, here we go. Yeah, dollar-yen chart. I'm going to go quickly to let's go to a daily chart instead for now. Yeah, I want to start with the daily chart. I may have talked about this briefly the day after it happened, but it's been 2 weeks since my last webinar, so I certainly didn't talk about it last week. A week ago today was the U.S. Thanksgiving holiday. As some of you already know, I'll try to brush on this really briefly because I'm sure some of you are already aware of this or have already heard this before if you attended the webinar 2 weeks ago. So I'll try to keep it brief, but I want to emphasize this move on the dollar-yen currency pair. This is the dollar-yen daily chart. That move, perhaps not entirely, but largely it seems on the back of expectations that leader of the Liberal Democratic Party in Japan, namely his name is Shinzo Abe. I did a video on this a week ago last Friday. Shinzo Abe, leader of the LDP, so-called LDP party in Japan, made some comments during a debate with Japanese Prime Minister Noda. This was 2 weeks ago yesterday. And Abe essentially said that he effectively wants the Bank of Japan to do a lot more to help stimulate the Japanese economy. A lot more meaning more quantitative easing, perhaps even lowering its benchmark interest rate to zero, and perhaps even make it negative. Although I don't know if that's really going to happen or be feasible, but nevertheless. He wants the Bank of Japan to do a lot more so-called easing policy, which would be, in fact, if the Bank of Japan followed through on that, a Japanese yen negative. So, as I've highlighted on the right-hand portion of his daily chart, we saw, in response to those comments by Abe, broad yen weakness. The implication is this, that if, and it's still an if, although voting polls suggest that Abe's party has a lead, although it's not quite a majority, there's a lot of division. Japanese politics is quite the mess right now. But anyway, amongst all the political parties, Shinzo Abe's party has a lead right now. And if Shinzo Abe were to become Japan's next prime minister, which would make us sixth or seventh in the past 6 years, it's like a revolving door and musical chairs when it comes to leaders of Japan. Anyway, if he were to take over, if his comments from about 2 weeks ago are any indication, he would certainly do all he can. This is probably including putting a new governor at the Bank of Japan in place to ensure the Bank of Japan gets much more aggressive in its easing policy. That's been the knock on the Bank of Japan for quite some time now, that in comparison to other major central banks like the Federal Reserve, like the Bank of England, like even the ECB, the Bank of Japan has done far too little, again, in the eyes of the market and the analysts and several economists and such in the media. The opinion of the consensus that the Bank of Japan has done far too little to stimulate its economy. And so what we have here in the form of this dollar-yen rise and some yen weakness against several other major currencies is markets begin to price in some expectation that that this LDP party may win the next election, scheduled, I believe, for December 16th, and then in turn Abe may put a new governor in place of the Bank of Japan, or who knows, maybe even the Bank of Japan loses its independence. It's a possibility. Anyway, that was the basis for the move. This move interesting when you compare it to the move we saw from mid-February to mid-March here on the left-hand side of this chart. That move, part of the basis of that move probably a so-called risk-on mood in global financial markets. Global stock markets are rising during that time, perhaps out of behind expectations of an improving global economy, plus probably the more relevant point is that right here, about right there, on February 14th, the Bank of Japan announced for the first time ever an inflation goal. And that was seen as a precursor, seen by the market anyway, as a precursor to the Bank of Japan possibly doing a lot more than it had done up to that point to stimulate the Japanese economy and perhaps lift inflation, permanently, or at least more permanently above flat and potentially to 1% their current goal or even higher. Well, as the year wore on, from mid-March on, we saw the dollar yen go more down than up, the Japanese yen stronger than weaker against several other major currencies. Of course, the concerns about Europe had a lot to do with that. The yen, a popular safe haven currency, so the Japanese yen has tended to gain strength when concerns about Europe have surfaced, which is there have been plenty of headlines, concerns about what's going to happen in Europe over the course of this past summer and such. But now that we're seeing, at least for now, things have stabilized in Europe, and concerns about a so-called Grexit, Greece leaving the Eurozone, and concerns about Spain, it seems at least have stabilized for the moment. Given all that, plus this political turmoil in Japan and the prospect of the Bank of Japan doing more aggressive easing policy next year, we've gotten a lift in the yen crosses, particularly on the dollar yen here. So the point I want to make here, and I'm getting to this in a moment, is let me raise this drawing tool and reset it. The point I made in the video that I put out about 14 hours ago was you see a lot of price action from late February to late April. A lot of price action around the 81.65 to 81.85 zone. You probably just make out two red lines defining that 20 pip zone between 81.65 and 81.85. So if you extend that 20 pip zone, you can just make out, and I'll show you this on a short time frame. Yesterday's low pretty much right at, or actually very close to, about 81.75, the middle of that 20 pip zone. So my point is this: it seems we're at today, tomorrow, we're kind of at a critical juncture when it comes to the dollar yen. We just bounced in this yesterday in this 81.65 to 85 zone that affected price action on the dollar yen so much for a 2-month period earlier this year. And let me zoom in now on an hourly chart. So here, on the right-hand side of this hourly chart, there's the bounce in the 81.65 to 85 zone. And yet, if you look at price action over the past several days, we seem to be in a descending channel. And we did approach the upper part of the channel during the early part of today's Asian session, but the dollar yen just lacked the mojo, if you will, to make a sustained rise above that the top of that channel. Plus, you notice the horizontal blue line on my chart, that's at 82.20. We've seen some occasions in the past few days where the 82.20 area seems to have influenced price action on the dollar yen as well. And then here during the early part of today's Asian session. I don't have a line at 82, but I should. 82, the psychological level, about right here. Actually, a little higher than that, but somewhere around there. So my thinking on the dollar yen is this. Well, I'm still wondering if there's going to be more upside for this pair, more weakness to come in the Japanese yen as we approach, the next couple of weeks, this election in Japan. Technically, you got to wonder if this run up in the dollar yen and the other yen crosses has already run its course or not. Maybe it has. But from a technical perspective, at least for now, there's a case being made for this for the general trend of this pair still to be up. This channel we're seeing right now, that's a common continuation pattern. So again, previous move up, retracement in the form of this channel. Possibly, I guess I stress the word possibly, next move up. So keep that in mind. In fact, let me reset this drawing tool. Again, the bounce around the 81.75 area yesterday was important. You could argue this is a higher low. So maybe not today, maybe not tomorrow. Or today is essentially in the books. Maybe not tomorrow, but eventually we can make a sustained rise above the 80-20 area and get out of this channel and continue to move to the upside. That's one thing to watch for. Now, if we start seeing a descent down to the bottom of the channel, perhaps a break below the bottom of the channel, then you got a different story technically. And perhaps the Japanese yen is going to firm up further, and we're going to see a deeper retracement of that broad up move in the dollar yen seen over the past 2 weeks. So sort of a critical juncture here, sort of a crossroads here for the dollar yen currency pair. And the point I want to make before I move on is that let me put the line at 82 now. All things being equal, let me make this a horizontal black line. Yeah, all things being equal, given the possibility of a continuation pattern here, given the bounce at this important 81.75 area here, given the higher low there, and again, given the previous move up sparked by again the prospect of the Bank of Japan eventually becoming a lot more dovish, a lot more aggressive in its monetary policy easing. Given all that, it's reasonable to assume that the next move could be up if you had to pick a bias. However, I would keep an eye on this range here, 82.20 to about 81.65, 81.75. I would focus on that range. And it's like 82 right now has some sort of gravitational pull on price action, has had for the past couple of days or so. My guess is this: the next move out of this range from about 81.75 to about 82.20, the next move out will dictate the next significant move on the dollar yen. Now, it doesn't mean if we go up to say if we break above 82.20, we're going to break above that high. My best guess is that the next move out of this 40 to 50 pip range, let's say we break above 82.20, then I would guess we're at least going to get here, perhaps hit there. We break below 81.65, and that brings levels like 81 or possibly even 80 into play. Doesn't mean the broader move up that we saw over the past couple weeks is over. Doesn't mean the basis for a longer term yen short play is over. You know, that could be dictated in part by what happens with this election on December 16th. And by the way, it could also be dictated in part by what happens with the U.S. fiscal cliff issue, which I want to get to in a moment. Yeah, Bob, daily pivots could come into play. Certainly, I wouldn't ignore that. Bob, another simple thing. Look at the 80.55 area. I've got a horizontal blue line at 80.55. And that's another area that's been important for the dollar yen in the past. I'm highlighting some price action earlier this year and some recent price action there. I mean, I wouldn't be shocked by a continued dip down to about the 80.60 area and then up. So again, I wouldn't totally rule out a longer-term long on the dollar yen if and when we dip below the this 81.65 to 75 zone I mentioned earlier. In fact, you could argue from a mere technical perspective that let me zoom in a bit on this daily chart. If you look at this recent move up, right there. Let me freeze this chart and use the fifth drawing tool again. So I've just done a fib study of the move up from low number 1 to high number 2. We haven't even done a 38.2% fib of that move. Here is a 38.2% fib of that move up from number 1 to number 2. So my point is, there's certainly scope for a deeper dip, and in spite of that dip, the recent uptrend could still be intact. So I don't know if we're going to get down to the 30.2% fib there. I don't know if we're going to get down to the 81.55 zone. That's been important on several occasions this year, but there is scope for more. Now, having said all that, if we do move higher, if we do break above 82.20, if we do break above that number 2 high there and continue up, you're looking at a rather aggressive move, similar in context, similar in speed, if you will, to the move we saw from mid-February to mid-March earlier this year. Yeah, fears over Europe are justified. I think it's reasonable to say that. Well, let me put it this way. It's very reasonable to say, and I believe this: Europe is not fixed. And by the way, if you're European, don't take that personally. It's not. I mean, we have our own problems here. In fact, the dominant headlines today, which I'll get to in a bit, were the so-called U.S. fiscal cliff issue. We've got problems here too. Don't make it appear that I don't want it to appear that I'm picking on the Europeans. I'm not. I'm a trader. I'm all about just whatever moves the market. So, but I mean, if you look at the numbers, if you look at the math, specifically when it comes to Greece, is Europe fixed? Maybe the better question is Greece fixed? Absolutely not. Many think, and I tend to think this is it's only a matter of time before we see another debt restructuring in Greece, perhaps another write-down of some kind. It's all the finance ministers did in their agreement earlier this week at the Eurogroup meeting. All they did was, again, many of you probably have heard the term "kick the can down the road." That's all that's happening right now. I suspect that they're just only delaying the inevitable when it comes to Greece. Spain off the front burner for now. Spain not a focal point for the moment, only because Spain has realized its funding needs for the year. Spain doesn't need to sell any more bonds to meet its funding needs for the rest of the year. Now, come next year, we'll see what happens with Spain and Spain's already cast its estimated budget for next year. But in terms of Spain's ability to tap the markets, we'll see what happens as next year rolls around. Also, probably worth watching the political scene in Spain too, particularly in the Catalonian region. Anyway, and by the way, some of you may not even trade the dollar yen because it makes very modest moves. Dollar yen not quite showing the volatility that the other yen crosses do, but I would keep a close eye on the dollar yen even if you don't trade it, because it is a good guide or proxy for the other yen crosses. For example, this 81.75 area I mentioned earlier. If and when the dollar yen, just simply put, let's put it this way. Activate the drawing tool again. Let's just do a little inset box here. Let's say you've got a notable area of resistance there, and you got price rising at some point in the future, and price the dollar yen price hits resistance, stalls there and turns. Very often, the other yen crosses, like the Aussie yen, the CAD yen, the Euro yen, pound yen, they do the same thing or some variation of the same thing. So dollar yen, again, as I've said many times before, a very good, a very good guide or proxy for the yen crosses. So even if you're not trading the dollar yen, even if you don't like the volatility or lack thereof on the dollar yen, it's worth watching this pair. Let me see some of the comments here. I need to catch up on chat, and I'm going to move on to next pair after that. So yeah, Bob, my take is that for the moment at least, now this could change as things often do, but for the moment at least, I sense that it's not so much at the moment fears about Europe that are front and center as much as fears about the U.S. fiscal cliff issue that are front and center when it comes to the markets, not just the currency market, but other financial markets. So I would say for the rest of the year, there's going to be more focus. I'm guessing more focus on the U.S. and the so-called fiscal cliff than on Europe. Now, don't take your eye off on things like bond yields, for example. By the way, speaking of bond yields, anyone notice today? Two Italian bond yields at the lowest in like 2 years. Certainly a euro positive, if anything. Yeah, Black Cat, I see your comment about we just kicked the can down further down the road, and again, you're not alone. Europe isn't alone. We're probably going to see some variation of the same thing here in the U.S. So Bob asked, would I wait for a bullish reversal pattern to show on the daily or 4 hour? So wait, Bob, are you considering like a long on dollar yen or long on one of the yen crosses? I mean, one option, Bob, is to long, okay. I mean, it's a very conservative. Bob, the point I was making earlier was this. Let me put another line at 81.75. I want to make this a green line. Again, the 81.75 or the 81.65 to 85 areas I mentioned earlier was important back in late February through late April, and we know recently here this 82.20 area has been important. So it's roughly the center of that range. The center of this range here is about 82. There's 82, and the range I'm referring to is right here. Bob, and we could very well continue the rest of this week and into parts of next week in a trading range. We may morph from this downward channel to a trading range, something like this. This range could continue. So, if you're a bull, what you might like to see is you could wait for something like a break of the channel, a break of this trend line. I say a break of this trend line in combination with the break of the 8220 area, and then a pullback after that. So what would that look like? I'm going to give you a couple examples. There's several examples as to how to play this. One example is something like this. Maybe not tomorrow. Maybe it's early next week. We get a break above all this. So it could be a retest for 8220. It could be a retest of the top of the channel that you look for along. I would certainly keep in mind something like that. And I'm not even incorporating things like moving averages or pivot points. Those could come into play as well as time of day. A dollar-yen long, say, for example, in the early part of an Asian session could be interesting. What strikes me about price action on this hourly chart is this. I mean, we certainly have yet to see a series of higher lows and higher highs yet, but I see dip there, and the dollar-yen had plenty of time to break below this 81.75 level, couldn't do it. During today's New York morning session, we had a dip and market bottomed on dip. So to me, it certainly seems reasonable to buy this pair on dips. And again, the question is, the dips to where? Well, maybe you wait for a rise first above this channel, above the 8220 area, and then buy on dip. I mean, you could, as an alternative, you could certainly look to buy again around, if you didn't buy yesterday, buy it again around the 81.65 to 85 zone. So a double bottom, perhaps, or something close to it. Yeah, that's an option. And of course, if you take a buy around 81.75 or something even higher, and you get knocked out, so be it. I mean, you could still be looking at the grand scheme of things and thinking, well, that there could be another buying opportunity at the 38.2% fib, which we haven't reached yet. I mean, look at that 38.2% fib around 81.40-ish. There's the 38.2% fib of the move up again from low number 1 to high number 2. And it seems to me the dollar-yen stalled quite a bit around the 81.40 area, around the middle of the month. So certainly a role reversal scenario there. Yeah, but we could feasibly do that. Work our way down to the bottom of the channel until to the 38.2% fib and then go up. Although the way markets moved recently, that any bounce or any notable next move up or down could very well be dictated by headlines. Headlines, for example, out of Japan before the election rolls around, or again, fiscal cliff could have something to do with it too. Yeah, again, a 61.8% fib, the 81.55 area. Interesting. The only reason why I'm emphasizing a so-called shallower dip and the prospect of the dollar yen continuing up, I cannot ignore. Let me go back to this daily chart and shift this over a little bit. I still cannot forget this move. And that was a very unidirectional move with very, very shallow dips. Now, what that move back from mid-February to mid-March, what that move had going for it, a risk-on environment, a broad rise across global equity markets. So the dollar yen had some help then. But as I saw based on correlation studies, that move in the dollar yen wasn't entirely based on a risk-on environment. It appeared to be also on the back of, well, of course, Europe wasn't front and center in terms of concerns then, but also it was that, at least part of that move was expectations about bolder accommodative policy by the Bank of Japan. And comparison-wise, it seems to me that we have, there's reason to believe we have a greater possibility of a more aggressive central bank now than what we had back then, because now we're facing things like the political turmoil and what it can mean, a changing of the guard of the Bank of Japan. It can mean the new Bank of Japan governor is going to be more aggressive. It could mean eventually possibly even a loss of the Bank of Japan's independence, which would be a Japanese yen negative, which would mean up for the dollar yen. And although the bond yields in Japan don't show it yet, but there's still some who think, and rightfully so, that Japan is a fiscal accident waiting to happen. I mean, debt to GDP ratio in Japan it's crazy. It's really out of hand. But it certainly hasn't affected the bond market yet. I believe the Japan's 10-year JGB just yesterday hit a new 9-year low. Yield. Anyway, it's something to watch here. Keep it on the dollar yen. Let's go to the euro here. Going to go to some euro charts with indicators. And like I did with the dollar yen, I'm going to focus initially on a chart without indicators. And I'm going to go to a weekly chart. This is a weekly chart for, 10 element. I've got more lines in this chart than I care to have. Clean this up a little bit. Yeah, it's pretty good. I first wanted to emphasize this is a weekly chart for the Euro USD. I wanted to emphasize this red downtrend resistance line base, and you can probably see it by now. High starting with I believe that's the first quarter of 2011. Last year's first quarter high, that might have been the April high. It might have been second quarter. But you see a high there, high there, high there. Now this looks slightly different depending on which trading platform you're using, but at least on this platform, and it's arguably a similar scenario, similar case on other trading platforms. I mean, we've got a trend line going back more than a year that sitting right near 1.30. Go to a daily chart, and there we are. We're right in the smack dab in the face of that trend line. So that's what we were faced with today. Number one, a trend line going back more than a year. It is a nice round number psychological level, namely 1.30, which has affected price action in the past. Let me show you an example of that. Look at the upper left-hand portion of this daily chart for the euro. I think it was like late February, maybe middle February through middle of April. There's 1.30 or close to it. 130 put a floor under the euro for several weeks there. Now, of course, the euro didn't respond that much to it more recently, but my point is that level's been important in the past. So not surprised technically at least the euro struggled around 1.30. Now any euro bears that took a short out near 1.30 got probably a little bit of help today. I don't know how many of you noticed, but there were some comments from some U.S. congressmen during today's New York morning session expressing concerns about the progress or lack thereof with these so-called fiscal cliff negotiations. So that's, for now at least, a hang-up when it comes to the dollar here. Let me show you an hourly chart for the euro. I thought what was notable is that we got actually a 4-hour chart is what I want to show you. So we talked about 130. We talked about the trend line. Actually, this trend line is redrawn in a way that isn't pertinent. But what I want to emphasize now is the 2875 area. The 2875 area represented by the horizontal blue line. You got lows there established in mid-October, high there established on November 7th, even some lows back here in mid-October. Hesitation here. And the bounce yesterday, during yesterday's New York morning session, that is at 38.2% fib with a move up, I think, I'm pretty sure I fibbed this from here to there. So the move from low number 1 on the Euro USD 4-hour chart to high number 2, 38.2% fib of that move, very close to yesterday's low around 28.75. And if I zoom in on the 15-minute chart, the Euro was stuck around 28.75, 28.80 during much of yesterday's New York morning session. The Euro rise got going yesterday when I believe it was U.S. House Speaker Boehner made some comments about essentially expressed optimism that a resolution or agreement would be made by end of year on the so-called U.S. fiscal cliff issue. So that was the start of a Euro rally. Now you could have just based on technicals alone gone long at or near 28.75, 28.80. But you got some help, it seems to me, on the back of those comments by Boehner, and the Euro's had been more up and down since until we reached 130. The Euro got stuck there, or at least stuck there during much of the day's New York morning session. Briefly spiked higher. Then we got more comments from U.S. congressmen today expressing doubts or concerns about the U.S. fiscal cliff negotiations, and the Euro was rejected then. As for opportunities, you could have gone long around the 28.75 to 80 area. Actually, we never reached 28.75, but we were certainly stuck around the 28.80 area. You could have been long there. I said this is a very viable option right there. Right just before London Open, you see the highs there, lows there. I mean, along around there, a very viable alternative to get yourself into a bullish euro position. Now you got knocked out. But I mean that trade from about 29.40ish up to 130. I mean, in the context of the recent price action, recent volatility, recent trading ranges. I mean that's a respectable 60-ish pip trade right there. Not bad at all. Again, the euro did decline after those comments by I forget the name of the U.S. congressman that made the comments, but U.S. House Speaker Boehner did express near the end of today's New York morning session some concerns about how the U.S. fiscal cliff negotiations were going. Just a day after he expressed optimism that agreement could be reached. So I guess the point I want to make was that let's highlight the two most notable moves. Let me go to an hourly chart here. Let me highlight the two most notable moves, arguably, this week on the euro. A rally there during the latter part of yesterday's New York morning session, and a continuation of that during today's early part of today's London session, and then a drop there. Now, you could argue at least part of the basis of these moves is technical, rightfully so. This 28.75 area again we knew was going to be important. The 130 level were important for many reasons. One of which I discussed earlier: the trend line, psychological level. I did mention there's a daily R2 pivot point near 1.30 today. But the point I'm making is that it seems to me, at least, the market is becoming more sensitive to headlines out of the U.S. Capitol. Headlines out of Washington, D.C., that is specifically comments made by U.S. senators and representatives with regards to the so-called U.S. fiscal cliff issue. So I'm telling you, folks, the U.S. fiscal cliff issue, we're in a market right now that's becoming more sensitive to that and less sensitive to headlines out of Europe. So get used to it. Yeah, thank you, Mr. Sir Boehner. Right, 29.40. Well, it's support for now. Probably make the case for a trend line, something like that. Yeah, well, or maybe actually that could even be a better one right there. Again, drop us to the trend line because that pertains to the weekly chart. Jack, if you're looking for Jack, if you're looking for simple answers here, I don't have anything for you. The point I want to make with regards to the Euro USD as we near the last few minutes of the session is that whether I like it or not, whether any of you like it or not, this market's probably going to become more sensitive to the U.S. fiscal cliff issue, and we can identify levels of support and resistance until we're blue in the face or talk about indicators like MACD or stochastics, which we do every day in our coaching sessions at Epics Bootcamp. But when it comes to significant moves, any significant moves could be very temporary fluctuations based on sort of knee-jerk reactions to comments out of Washington, D.C. I mean, again, we dealt with this sort of thing quite a bit back in the summer and early fall with regards to headlines out of Europe. Now, Jack, if you're going to ask me what could the euro do next, even if the euro is more bullish and bearish, I mean, Jack, we could very well do something like this. I mean, this is not a prediction. I don't want credit for it if I'm right, but we could even do that and then head up. Anyway, the market's got some things to sort out. It is worth noting, though, that I'd like to see where the euro resides around tomorrow's London Open. Because let's face it, we got the bounce during yesterday's New York morning session. We got a nice rise during today's London session. Yeah, we did run into a notable ceiling at 1.30. I'll be interested to see what London finds when where London traders, where European traders find the euro at tomorrow's London Open. That would be about 25 hours from now. 25 hours from now, where's the euro going to be? If the euro is at any reasonable source or preferably source is of support, we could see another euro rally. But again, the point I'm making is this: whether you like it or not, you're going to have to. I feel like increasingly as a trader, you're going to have to keep track of some of the headlines and some comments by U.S. officials with regards to the fiscal cliff issue. It could very well dictate a lot of price action over the coming days and weeks. Yes, thank you. I don't know what I said, but yeah, tomorrow is Friday. I promised I'd touch. I know we're nearing the end of my scheduled session here, but I promised I would touch on a look ahead. I did mention briefly some central bank decisions next week and a lot of news next week. The Australian dollar. That's other than watch say the yen crosses and what the dollar yen does, and dollar yen again a decent guide or proxy for the yen crosses. Keep an eye on that. Certainly keep an eye on headlines out of the U.S. with regards to the fiscal cliff issue. That could guide price action on the Euro USD in particular, U.S. dollar in general. As we see optimism about the U.S. fiscal cliff issue usually means up for the euro and some broad weakness in the dollar. Pessimism or just concern about it can mean down for the euro and some broad weakness in the dollar. So keep an eye on those things. Beyond that, the Aussie. The Aussie certainly is getting interesting. And early next week with this RBA policy decision could really dictate, the entire month, all of December and the rest of the year, of course, for the Aussie. Maybe it's just me, but it seems the Australian dollar has been under some pressure of late, certainly at least today. While the euro has made some strides to the upside, the Aussie, you can see here you've got a case for like a broad trading range in the Aussie. While the euro reached 1.30, its highest level in whatever, how long, what weeks, the Aussie has yet to challenge. This is the daily chart for the Aussie. Aussie has yet to challenge the high seen in early August and about mid-September here, around 1.06. Why is the Aussie weighed down? Well, at least a couple reasons. Well, one reason, maybe not so much a factor now, there's been some ongoing concerns about a notable slowdown in China. Maybe not so much a concern now, given the China manufacturing PMI figure released before the U.S. Thanksgiving holiday last week. The private HSBC rating on China's manufacturing sector was above 50 for the first time in several months. So, there maybe there's some declining, some lesser concerns about a notable slowdown in China. Plus, there was a leadership transition earlier this month, and that could have weighed on the Australian dollar a bit, as the markets were concerned about what that could mean again for policy implications, fiscal policy as well as even central banking policy for China. And how much that could slow down the economy or such. But beyond that, another reason why the Australian dollar has made less strides up against the U.S. dollar than the euro has, probably chalk it up to an increasingly dovish-sounding Australian central bank. If you look at the latest release earlier this month of the minutes of the last Reserve Bank of Australia meeting, that central bank looks inclined to cut rates, and there's been some speculation for several weeks now, actually almost months, that the Australian central bank will cut rates one more time. Well, their next meeting is next week. I believe it's during next Tuesday's Asian session. Let me check this. Checking the news calendar here. I know, I'm going to wrap this up. Yeah, next Tuesday's Asian session, it's actually 10:30 p.m. New York time next Monday. What is that, I don't know, 3:30 GMT next Tuesday? That's the next RBA or Australian Central Bank policy decision, specifically rate decision. Again, one consensus forecast I'm seeing is for no change, but there is at least some speculation that I'm hearing from various sources that of one more rate cut. Anyway, that could certainly dictate, or speculation in advance of that RBA meeting could dictate price action on the Australian dollar against other major currencies for tomorrow and Monday. But what the RBA does or perhaps doesn't do could certainly dictate the tone of the Australian dollar for really the rest of the year. I mean, if the RBA cuts and continues to sound rather dovish, Australian dollar could retain a somewhat weaker tone for a while. I mean, at least again through the end of the year, especially on days when we get a risk-off mood on the back of concerns about the U.S. fiscal cliff issue. If the RBA does not cut rates, if the Reserve Bank of Australia leaves its benchmark interest rate at 3.25%, despite some expectations or some speculation that they may cut, that could give a boost to the Australian dollar, and that could hold up, especially if we get some good news out of China from the next PMI report due out, I believe, over the weekend. Yeah, Gam, you're right. I just don't know if if they're going to fall through on that before the end of the year. Yeah, the Aussie its move certainly next Tuesday and to some extent beyond could depend on the tone of the RBA statement. So, for example, on the RBA decision during next Tuesday's Asian session, even if they don't cut, I'll be paying close attention to the language in their statement. If they still sound like they're poised, the next move is going to be a rate cut, then the Aussie could still drop even though they don't cut rates at the next meeting. So watch for that. Well, I've gone beyond my time. I apologize for that, but I'll be around for as long as FX Street wants to keep the room open, although I think they usually shut down this room in timely fashion long after I end the session. So keep that in mind. But a couple final notes. If you anyone who wants to contact me after this webinar, just send me. I don't know if you want to send me an article or ask me a question or whatever. Feel free to do so. Tom, if I have time, I can cover that briefly here. Hang on. Here's my email address. I'm available, by the way, for private mentoring, one-on-one mentoring. Feel free to contact me about that as well. So Aussie, Tom, on the Aussie, then, mid or long term, I favor selling the Aussie in the near to medium term, really. Until the Australian Central Bank changes its tune. I mean, we're seeing some stabilization. Well, I don't want to make too much out of one single data point, but that was an encouraging data point in terms of the HSBC China manufacturing PMI figure released last week. But I don't know if the market's drinking the Kool-Aid quite yet in terms of believing that all is clear when it comes to China and its economy. But GAM has a valid point. The Australian Central Bank certainly has been adamant to varying degrees about the strength of the Australian dollar, and are perhaps concerned about that. So they may over time make a more deliberate effort to weaken the currency. So the simple answer, may not be the right answer, but the simple answer is over time, and until the RBA turns less dovish. Sounds less inclined to make their next move a rate cut, then I'd be more inclined to just look to sell the Australian dollar. Oh, it doesn't show? Oh, sorry, I didn't make it public. Sorry about that. I send this to the host. There you go. You should see that. There's my email address. So, Tom, if you ask me right now, I'm still inclined to want to short it until I see the RBA change their tune. And again, they might, although it seems that they just changed their tune recently to being more dovish, to be more inclined to cut rates. So they're not the kind of central bank that flip flops a lot in my experience. But until they're until they change their tune, I'd be more inclined to sell the Australian dollar than buy it. Also, keep in mind that the Australian dollar has been a favorite of the carry trade, and one popular carry trade of late has been selling the Euro Aussie. And with at least some stabilization in Europe and perhaps some renewed confidence about at least Europe successfully kicking the can down the road, that means that could mean further upside on the Euro pairs, which includes the Euro Aussie. And I've seen several days if the Euro Aussie is just rip-roaring, rallying higher, then you very often see Australian dollar weakness against other major currencies as well. Yeah, Gam, you're right. You're absolutely right about the tension between China and Japan in the long term. But until something more, that's something worth watching when it comes to the election here. The election in Japan could be a factor there. I don't. Someone correct me if I'm wrong, but I don't sense in my reading about Shinzo Abe that he is. I don't sense he's the kind of guy that's going to be real friendly with China. Could be wrong about that, but I don't sense he's going to be. So if he wins the election, if his party wins the election, he becomes prime minister. Bob, I tend to prefer to trade the Aussie. Actually, Bob, here's what I prefer to do, and I really need to wrap this up. And I apologize to anyone at at FX Street for sitting around waiting, is they're probably thinking, is Curt going to finish? Is Curt going to finish? Well, I do determine past my normally a lot of time at times. So, but I'll answer Bob's question, and beyond that, feel free to send me an email, and I'll be happy to reply to that. Bob, with regards to trading the Aussie rate announcements, what I prefer to do, my personal preference, rather than take a trade after the fact. Let me undo my drawing tool here. Rather than taking the trade after the fact, after the decision, if I had a choice, I'd rather speculate about what will happen and get into a position well before the rate announcement, like, say, Monday's New York morning session. If an opportunity presents itself, I'd like to get in that way. Now, of course, I've been wrong my fair share of times about what the RBA might do, or more specifically about the market's reaction to what the RBA does or doesn't do. But I'd almost rather do that, and I'll tell you why, Bob, and I'll end up with this note. Too often I've seen, I promise I'll end up with this note. Too often I've seen this. When it comes to looking for a trade the day of an RBA rate decision, you see a white space here. Here's what I've seen far too often. When there's been a surprise, let's say, even though the consensus forecast I'm seeing right now calls for no change by the RBA, let's say the RBA cuts rates. Far too often I've seen on a pair like the Aussie USD, I've seen this. Sharp drop in the Aussie during the Asian session, and then stalls. Sometimes stalls for the rest of the trading day. Maybe it leaks a little lower through sometime like in the New York morning session, but I don't know about you, but that's hard to trade. I don't like just jumping in, head first the moment I hear a rate cut. You get a bad fill, and sometimes you get a reversal. But so I'd rather, in terms of trading, I'd rather position myself in advance, hope that I speculate on the right outcome, right move or lack thereof by the RBA or whatever, and then or if I'm wrong, or if I don't take the trade, if I don't get a trade to position myself in advance of the RBA decision, let the thing play out, let the price action play out, and look the next day to take on a position based on the RBA outcome, whatever it is. Folks, have a great day. Thank you again to everyone, especially at Epic Street, for making this event possible. And again, feel free to contact me by email. In case you missed my email, let me post it one more time. Whether it's questions, about what I discussed here, maybe if you have questions about anything else I didn't discuss, feel free to, if you want to send me charts to look at, I'll look at charts. I'll comment on that. If you have any questions about private mentoring, contact me about that as well. Have a great day, folks. Thank you. Cheers.